All weekend long, the warnings were everywhere. Analysts said the rally was finished. Commentators declared Friday's move the final gasp. Social media was filled with advice to take profits before it's too late. But markets don't care about opinions. They care about pressure. And this morning, Monday morning, the pressure spoke loudly. What unfolded wasn't a normal trading session. It wasn't optimism, hype, or retail enthusiasm. It was something far more dangerous for the system: forced action. This is the story of a market that refused to obey expectations, and of what happens when those who thought they were in control suddenly realize they aren't. They said it would roll over. They said Friday marked the top. They said smart money was already heading for the exits. Then Monday arrived and the market delivered its verdict. A single green candle erased the entire bearish narrative in less than an hour. Silver is now trading at $69.14, after touching $69.40 earlier in the session. That's nearly a $2 move since the open, almost 3% in one day. On a Monday, that kind of move doesn't happen in commodities unless something breaks or someone panics. This isn't a speculative trade. This is a liquidation event. The institutions that pressed their shorts on Friday are now trapped, deep underwater. And when banks get trapped, they don't negotiate, they react. They buy fast, desperately. They're scrambling to close positions before silver prints $70, because they know exactly what that level represents. Once $70 breaks, the human element disappears. Algorithms take control. Liquidity thins out. And price enters what traders call a vacuum, a zone where resistance vanishes and price accelerates straight toward $75. Today we're breaking down the Monday reckoning for short sellers. We're looking at the volume behind the move, the psychology of the $70 barrier, and why this moment feels different. Because this isn't just another rally. This is what it looks like when suppression stops working. To understand the intensity of today's move, you have to rewind to Sunday night when Asian markets opened. There was no hesitation, no dip, no probing of support. Price gapped higher and kept going. Technicians call this a gap and go. Normally gaps get filled. Price pulls back, tests the previous close, lets late buyers in. But not this time. Silver opened strong and climbed higher without looking back. That tells you everything. It means buyers weren't waiting. They weren't bargaining over pennies. They weren't hoping for a pullback. They needed exposure immediately. Retail investors don't behave like that. Hedge funds don't behave like that. Only forced buyers behave like that. The kind of buyers who just received a margin call. The kind whose broker said, "Close it now or we will." That confirms what many suspected over the weekend. The margin calls were real. Banks spent the last 2 days calculating Friday's damage. This morning they pulled the plug. What we're watching is forced liquidation in real time, financed with the bank's own capital. Now look at the session high, $69.40. Why did we pause there? Why not push straight through $70? Because $70 isn't just a number. It's a psychological fortress. Round numbers attract profit-taking. Day traders see them as exits. As silver approached $69.50, short-term traders locked in gains. Here's the key detail: the market didn't collapse. Instead of falling back to $67, silver pulled back slightly, to $69.14 and held firm. We're camped just beneath resistance. In technical terms, this is called knocking on the door. Picture a battering ram hitting a castle gate. The first strike weakens it. The second cracks it open. $69.40 was the first strike. The fact that price is holding here, consolidating, absorbing supply, suggests the market is loading up for another attempt. Every contract sold near $69 is being immediately bought. Sellers are getting exhausted. Eventually, there's nothing left to sell at $69.99. And when that happens, price doesn't crawl through $70, it jumps. Now imagine the scene inside a major bullion bank in New York. On Friday you thought you had control. You believed $65 would cap the move. Today silver is $69. You're down $4 per ounce on millions of ounces of paper exposure. Your P&L is bleeding. Your risk manager is hovering behind you, demanding action. Doubling down isn't an option. Risk limits are maxed out. So you do the only thing left, you cover. But every contract you buy pushes price higher. Your buying triggers another bank to panic. They buy. Price jumps again. That forces the next desk to react. This is the doom loop for shorts. They're all trying to escape through the same narrow door, and it's getting smaller by the minute. That's why the rally feels relentless. This isn't greed-driven buying. It's fear. Fear of losing control. Fear of balance sheets unraveling. And notice something else. Turn on financial news. Is silver exploding the lead story? Probably not. Headlines are focused on stocks, rates, tech earnings. That silence is intentional. A surging silver price sends the wrong message. It screams inflation. It questions the dollar. It exposes managed money losses. The media blackout is actually bullish. It means we're still early. The public hasn't arrived yet. No mainstream frenzy. No late cycle hype. This move to $69 is being powered by institutional flow and desperation, not retail euphoria. And that's the healthiest rally there is. Now add the wild card, the calendar. It's late December. Holiday season. Senior traders are leaving desks. Volume is thinning. Normally that means calm markets. But in a squeeze, thin liquidity is dangerous. When desks are understaffed and sellers disappear, a single large buy order can move price dollars, not cents. There's no resistance. No shock absorbers. That's the setup we're entering now. In part 2, we'll break down the holiday liquidity trap, why low volume doesn't mean low volatility, why junior traders are more likely to panic, and why a break above $70 in this environment could launch silver straight towards $75 before anyone can react. The banks are hoping for a quiet holiday. They're not going to get one. All roads are converging on a single number. $70. In part 3, we turn our attention to the real battlefield. The technical wall. Because $70 is not just a price. It's a line drawn across decades of inflation-adjusted charts. It's the final defensive perimeter for the banking cartel. And today we're going to explain why breaking $70 doesn't just continue the trend, it changes its nature. This is the point where linear movement gives way to acceleration. Where targets stop being incremental and start becoming open-ended. Above $70, the sky clears. And when silver starts with a 7, perception changes. Overnight. Cheap turns into momentum. Curiosity turns into urgency. The fight for $70 starts now. And in a market this thin, that wall may not be stone, it may be paper. Stay with us. This is part 3. We're mapping the breakout. If you're just joining us, here's the scoreboard. Silver is trading at $69.14. We're up nearly 3% in a single session. Friday's sell-off has been erased. Low-volume warnings were ignored. And now we're standing directly in front of $70. This level is not cosmetic. It's a fortress. For decades, silver has lived in a controlled environment, prices capped, momentum suppressed. First it was $30. Then $50. Now $70 is the final wall. The last place where control can still be asserted. In part 3, we're dissecting why this price is the kill zone for remaining shorts. What happens when an asset pushes into territory with no historical ceiling? And why the first digit changing from 6 to 7 rewires how both institutions and the public behave. The battering ram is swinging. The gate is cracking. Let's see what's on the other side. Why does the market care so much about $70? Why not $69.80? Because humans are not rational. We're wired to respect round numbers. In trading, this is called big figure resistance. When traders see a 7 at the front of the price, their instincts scream expensive. Funds front-run it with sell orders at $69.99. Option writers defend the $70 strike to avoid payouts. The level reinforces itself until it doesn't. We saw it today. Price reached $69.40 and recoiled. That was the warning shot. The defenders showed up. But here's the paradox of squeezes. Round numbers repel price, until repeated pressure turns them into magnets. If silver prints $70.01, it doesn't stall. It detonates stop losses. Every short who thought $70 would hold has a stop sitting just above it. When those stops trigger, they become market buys. The wall instantly turns into fuel. That's how resistance becomes acceleration. Now zoom out. 1980, silver peaks near $50. 2011, silver peaks near $49. Today, silver is at $69. Think about what that means. There is no price memory above us. No crowd of trapped sellers waiting to break even at $75. Those people don't exist. When an asset enters a range it has never traded in before, it enters blue sky territory. In blue sky, traditional technicals lose relevance. No old highs. No overhead supply. No historical anchors. Only momentum. Price doesn't stop because it's too high. It stops when someone is willing to sell. And when everyone is already in profit and convinced it's going higher, selling disappears. That's how prices overshoot. That's how $70 becomes $80, then $90, not because of fundamentals changing overnight, but because psychology does. Right now, the only resistance left is artificial. Once it's overrun, there's nothing but open air above. There's also a subtle but powerful shift that happens when the handle changes, the first digit of the price. We've seen it before. $19 to $20 changed perception. $49 to $50 ignited mania. Moving from the 60s into the 70s flips the narrative entirely. To retail investors, $60 feels like high $50s. But $70 feels dangerously close to $100. Once silver trades at $72, people stop looking back to $50. They start looking forward to triple digits. That's when momentum traders arrive. The ones who only buy new highs. This is reflexivity in action. Higher prices attract buyers, and buyers drive higher prices. Breaking $70 doesn't signal the end of the move. It signals validation. The risk flips. Not owning silver becomes the dangerous position. Now let's talk about you. If you're holding physical silver, today wasn't just profitable, it was psychological. A 3% move does something powerful. It creates the wealth effect. You feel smarter, more confident, more patient. That confidence is poison for the shorts. The banks are counting on you to sell. They need you to see $69 and say, finally I can get out. But that's not what's happening. You're seeing $69 and thinking, I was right. That's the problem. A confident holder doesn't sell. They buy more. Paper can be printed. Conviction can't. If nobody sells at $70, price moves to $71. Then $75. Then wherever it needs to go to break that confidence. Right now, greed is beating fear, and that's lethal for shorts. Now consider the industrial side. Procurement managers at Samsung, Tesla, solar manufacturers, they're watching the same chart. At $60 they were irritated. At $65 they were uneasy. At $70 budgets break. That's the level where CFOs get phone calls. Where forecasts fail. Where just-in-time inventory collapses. If silver breaks $70 this week, industrial buyers won't hedge next month, they'll hedge next year. They'll front-load demand to avoid catastrophic pricing later. That pulls future demand into the present. That's how markets go vertical. Industry doesn't react to price, it reacts to trend. And the trend is screaming urgency. So yes, $70 is the key. Blue sky is open. Industry is on edge. But markets are treacherous, especially during holiday weeks with thin liquidity. What if we fail? What if banks engineer a fake breakout and slam it lower? And if we do break through, how do you survive the volatility? That's what part 4 is about, the endgame. The New York session is closing. The bell has rung. Silver finishes the day at $69.14. Pause for a moment and absorb that. The banks tried to crash the market on Friday. Failed. They tried to scare you out. Failed. And on a quiet pre-holiday Monday, silver rallied nearly 3%. That's not noise. That's a message. The hard part starts now, holding. Holding losses is easy. Holding gains is brutal. The urge to lock it in is overwhelming. So here's the plan. There are only two numbers that matter. First, $70, the ceiling. A high-volume daily close above it confirms liftoff. Second, $67, the floor. Friday's resistance becomes today's support. As long as we hold $67, the trend remains intact. Below $67? Reassess. Above it? Do nothing. Let it work. And one final warning, do not use leverage. Holiday markets are violent. A $5 intraday swing can wipe out leveraged positions instantly, right before price snaps back. Banks know this. They hunt leverage. Physical silver has no margin call. No counterparty. It doesn't panic. That's how you survive a supercycle. The sellers are gone. Shorts have closed their books. Drift takes over. Low volume doesn't mean weakness, it means no resistance. We've broken multi-year consolidation. We've cleared psychological barriers. This is not the top. This is recognition. Silver isn't being repriced for speculation, it's being repriced for reality. So watch $70. Respect volatility. Hold the physical. Ignore the noise. The banks lost control today. You didn't? The Monday massacre belonged to the bulls. Let's see what Tuesday brings.